Biztech's Investor Conversation show. Our guest for today is Shashwika Ravishankar. She's the partner of private equity at Heidrick Struggles. Now, Heidrick Struggles, which is listed on NASDAQ, serves the senior level talent and leadership needs of the world's top organizations as a trusted advisor across executive search, leadership assessment, and development, as well as organizational and team effectiveness and culture shaping services. That's quite a lot. But then, welcome to the show, Shash. Good to have you back on Biztechasia.
Pleasure, Brian. Thank you for having me.
Now, Sasha, I want to zoom in then on the crux of this interview, which is related to the company's recently released annual Asia Pacific Private Capital Investment Professional Compensation Survey. Could you walk us through the context of this survey and then some of the key findings?
Yeah, I think we're coming out of one of the busiest investment cycles, Brian. I think the past decade in private markets has certainly been high octane. A lot of people I speak to called it the golden decade for private markets. I think that was shaped by highly favorable market conditions, ultra loose monetary policy, low interest rates, which really led to this boom in terms of leverage buyouts. We also saw private equity firms really broaden the scope of what they do, away from leverage buyouts into infrastructure, real estate, credit, particularly in the aftermath of the financial crisis, where banks started to retreat, and I think credit as an asset class really emerged. We saw bigger funds being raised. We saw investors flocking to private markets, given the favorable returns. On the other hand, deal making was also at record levels. The bidding process had sped up considerably, but then we also saw this formative moment in the industry where a number of private equity firms went public, listing on stock exchanges. We saw acquisitions at fund level. We saw firms strengthen their footprint in order to enter new markets and strategies. But I would say quite a bit has changed in the last in the last 6-8 months or so, driven primarily by market uncertainty. But we've also seen a change in the old guard at the top of a number of big firms. I think the urge to IPO for a lot of funds has been a formative moment, which has changed the dynamic quite a bit. But there's also, as private equity has matured as an asset class, we've also seen greater scrutiny from a regulatory standpoint. So I think these forces have really sort of shaped, private markets in a significant way. I just want to spend a minute, Brian, kind of delving into each of those topics, because that really sets the context for the results from our survey. Free money and cheap debt being gone, that's the lifeline of the industry.
Absolutely.
When you couple that with the level of dry powder and the increased competition for deals, it's meant that buyouts have gotten more expensive. The average price to earnings is at an all-time high. And for a lot of PE firms, there's no room for error. You absolutely can't get it wrong. As a result, I think firms are starting to be a lot more conscious about governance. Active monitoring is the name of the game. PE firms are being careful to not appear to be too founder or CEO friendly, having more independent directors on boards, having more advisors to advise pre-deal on due diligence, particularly in sectors that are new to them. Added to this situation, you have this very complex fundraising environment. LPs, I think, have been building direct investing teams for the longest time, and they've gotten far more sophisticated. They can also take a 25-year view where a PE fund doesn't have that leisure. So they are less keen on paying that 1.5 or that 2% of management fees. So what we've seen is GPs are starting to tap into retail investors. They're buying, they've stepped up their purchases of books of life insurance or annuities, right? So they're tapping into these perpetual long-term pools of capital to avoid going out to fundraise every few years. So we're seeing.
Yeah, and I've got to just interject there, because that's a fundamental shift in the last couple of years that we've seen in markets, really going out to and you highlighted two key things. One, not going into market to tap funds every few years. The second thing is going down to the retail level, making it, giving smaller ticket sizes then, and getting people into the industry that perhaps were not customers before.
Yes. And this allows them to think to sort of tap into these longer term pools of capital. And it allows them to think differently about deals, to think more long term in terms of holding periods. So I think that's been the change from a fundraising perspective. But also, this is a moment in time where these guys have all gone public, right? Or a lot of the big firms have gone public. And this is a formative moment because it's a way that private equity firms monetize future flows of management fees. So once a firm goes public, the way to boost the stock price is to maximize management fees. The focus then becomes AUM. It's all about scaling up. It's about bulking up. It's about raising new funds and new strategies. And so the challenge then in private equity becomes, how do we get bigger whilst maintaining returns? And I think this is something that the big firms are grappling with.
And so given that, and so that's all then related, and thank you very much for giving us just that overview of the industry, some key trends that have shaped the industry, but then how does that then impact the compensation then of the teams? As you are bulking up, of course, there's a war for talent.
Yeah, no, there is. And I think the demand for talent is still quite high, and it's still the highest it's ever been. But this is also an industry that's in the throes of change and one that's being reshaped. And I think with that comes uncertainty. But there's also a considerable opportunity, and I think the longer term future may well be bright. What we've seen reflected in the compensation survey that was conducted in Q4 last year was that investors in the region have expressed a somewhat neutral market sentiment across markets in the region. However, the longer term compensation trend is certainly upwards. And as you rightly pointed out, Brian, that is because the demand for talent is quite high. Let me sort of explain that a little bit and tell you where that demand is coming from. At the top end of the market, I did say the big firms are raising bigger flagship funds, new sector funds, new thematic funds. You need more talent to deploy it. You need more boots on the ground. So I think the demand is still coming from the big firms, but you've also got a bifurcation that's happened, right? As the big firms have gotten bigger, you see this long tail of sort of smaller, artisanal, sector-focused, market-focused funds that have popped up. And these guys have good returns, and the value proposition is quite compelling. If you're someone who is not at partner level, you see a lot more room for growth, and this idea of being more entrepreneurial and setting up a fund becomes a very compelling one indeed. And then the GP hiring, this is the other bit that we were talking about. You know, as GPs want to go direct and build out direct investing teams, they're also looking to beef up, and they're also looking to hire. So I think all of that has sort of added to the demand, if you like, for investment professionals. And this is a very interesting time in the industry.
Now, one of the things that would be interesting then is there's a war for talent, there's a finite pool, you've got funds that are bulking up. Are they looking more laterally at talent as well, rather than coming in from an existing fund, people who have perhaps more people with an operational background are then being brought into these funds to bulk them up from a domain expertise perspective?
Yeah, so let's maybe take an example of a healthcare growth fund, for example. You need folks who understand the science and the innovation behind a biotech company. There might be two firms that look very similar in terms of their balance sheet and their numbers, but the outcomes are likely to be very different because the technology and the science behind one may be quite different from that of the other, which would shape the trajectory of those two businesses. So I think you require this understanding of the science and the innovation, in addition to the skill sets that you already have in terms of financial modeling and deal origination, and all of that. So I think the interesting thing is, as the industry has gotten bigger, I think specialization has become important, right? Because you've got these deeper funds, you've got these thematic funds. And so I think the type of talent that they're looking at certainly has changed. I think the operating partner piece is quite important, Brian, because value creation, given where multiples are, it's less about multiple expansion and it's less about adding leverage, right? It's interest rates are where they are. So it's not about multiple expansion and it's not about leverage. I think the focus is going to be top line growth. It's going to be cost improvement. It's going to be capital efficiency. It's going to be M&A. And that requires a whole range of skill sets that these firms need to account for.
And where are they hiring? So where are the large firms hiring, and where are the artisanal firms hiring from?
Yeah, I think the large firms, for one, if I were to talk about buyout, I think PE has moved away from large leverage buyouts to more sort of mid-market, as well as platform buy and builds. So I think the sort of buy and build market has been quite resilient. So this is smaller transactions requiring less debt, and they've grown in market share. You've also seen a lot of add-ons in terms of using balance sheet money to really, build platforms. So GPs are buying smaller companies at lower multiples, but they're really sort of building them up to create larger companies which command higher valuations, right? So this requires a lot more due diligence. It requires a lot more integration work in terms of figuring out how the pieces fit together, right? So this has meant that they've had to really hire a lot of folks at pre-partner level because the execution aspect of it has become a lot more challenging and a lot more complex. You couple that with having to hire from consulting firms, particularly because the operating partner skill set is a very important one. I think they're also looking to solve for topics like digital transformation, for example, within their portfolio. So that requires a degree of tech expertise. So I think we're seeing sort of PE firms widen the aperture of where they hire from, what good looks like. And I think part of that has been this increased volume and the amount of work that you have to do in order to get to the same outcome.
That's interesting because then it comes down to dollars and cents as well. Now, what sort of salary increases are we looking at? Of course, we've had, as you said, a golden decade.
Yeah.
And we, in the last 6 months, obviously, that whole market situation has turned. More recently, obviously, we have a banking crisis. So everyone is basically nervously looking over their shoulder. But from your lens across the APAC region, where is, and also as a result of that survey, where are people reporting increases in base salary and overall compensation?
Yeah, I think for this year, we haven't seen a significant increase in bonus. Part of that has been slower deployment. I think fundraising has been more challenging. So we're not seeing this large increase, if you like, in compensation, be it base or bonus. The timing of the survey is critical, Brian, because we did this in Q4. Typically, PE firms value their assets at the end of the year, right? Mm-hmm. So there might have been a little bit of a markdown from a carry perspective to sort of account for what we're seeing in the public markets as well. Right. But we did not get that data given the timing of when this was conducted. So it'll be interesting to see how that plays out over the course of the next 12 months. But I would say we haven't seen a significant sort of increase in cash compensation, particularly because of market uncertainty and because of what I just described as slower deployment, but also challenging fundraising conditions. However, the longer term dynamics are still positive because you've got a lot of funds to deploy. You've got new strategies that you're looking at, new markets that you want to enter. So I think the longer term prospects are still quite strong, but really what we've seen is a short term dip. Now,
Sash, has the way compensation is structured changed? And I use this specifically related to carry, because if you've got a war for talent, you've got bigger funds to deploy. How do you attract the top talent to move from one firm to the other? The carrot is probably not base compensation, it's probably carry. How are you seeing that evolve? Is carry going down, cascading lower than perhaps than it has been in the past?
Yeah, and this is where I think the smaller firms do well to attract talent, because they still try to keep to the 1.5% or 2% and the 20% carry model. And because they're still small, they prioritize returns. I think they've done quite well to attract talent by focusing on carry. I think at the top, within particularly the publicly listed firms, I did talk about how it is an AUM game. I think the 2% or the 1.5% of the management fees now are being heavily rewarded, right? So we've seen a slight shift towards management fee versus or management fee versus performance fee, I think, as you think about the makeup of executive compensation at the top. So I think that's been the fundamental difference between the big firms and the small firms.
Okay, and how are you seeing, because of these shifts that are happening now, there are obviously, and given the scenario around banking, around consulting and so forth, it's a different level of skill sets. And you want, as you said, you would want people coming in to artisanal firms, to larger firms as well, and also coming in at different levels, coming in at mid-levels, coming in at senior levels.
Yeah.
If I'm a mid-level manager in a consulting firm, I've never done private equity and so forth, I'm looking for a career change. I've worked in tech, I've worked in digital transformation. How do I get into this business? And then that's the first question. And the second question, then, I'm a senior person. I'm 50 plus years old. I've had operational roles. I'm a senior guy in banking. I'm a CIO, a chief in an insurance company. Obviously, I'm a great fit for this industry. How do I get into this industry?
Yeah, I think the second bucket, the demand is always high, right? If you're a PE firm, for example, that's looking at the EV space, right? They don't have that capability. So if there is a senior executive or there is a senior leader that has that very sort of specialized skill set, I think it's very valuable. It's valuable at pre-deal kind of advisory level. You're looking for these guys to take on active board roles, investing alongside these firms, be this very active board member, working with management to really, drive value creation. And you can also sort of partake in the upside that comes with it for a lot of these people. So I think it can be a very compelling proposition indeed. It's about choosing the right firm to partner with, a firm where you think the sort of focus on the industry or the skill set that you bring will manifest and will sort of manifest itself across a number of deals within the fund. I think that's the way to make the most impact. If you're a junior person, a more junior or mid-level, a mid-career individual sitting within consulting, I think what you need to do is you need to kind of figure out how you're going to get those sort of years of operating experience, either in the context of a high growth startup, but I think the operational experience coupled and the execution experience coupled with strategy, I think that's what they're looking for in operating partners. So I would say for a mid-career consultant, get out, get a couple of years of operating experience if PE is interesting, because I think it's important to have both strategy and execution come together in that kind of operating partner role.
Sash, it's been a fascinating conversation and really enjoyed this. And you gave us a lot of insights. But before we leave, any final thoughts you'd like to leave the audience with?
Well, I think it's going to be an interesting few years to see private markets continue to evolve and develop. I'm particularly excited about the infrastructure space. I think that's a space where we see a lot of deal flow in Asia. And we didn't talk about that, Brian, but I do see infra really starting to emerge as an asset class. And I think it lends itself quite nicely to the macro uncertainties that we're dealing with. So I do think that infra and credit will boom and will do very well this year. So yeah, I think it's going to be exciting times ahead, and we'll see how the firms sort of navigate the coming months of uncertainty.
Sash, it's been great having you on your show. Thank you very much for coming on.
Thank you. Thanks for having me, Brian. It's been a pleasure.
Now, we've been speaking to Shashwika Ravishankar. She's a partner private equity at Heidrick Struggles. I'm Brian Fernandez, and you've been watching and listening to Biztech's Investor Conversation Show. This interview will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.